In this video, I'm going to talk about shakeouts. One of my YouTube subscribers wanted to understand what goes behind a shakeout. A shakeout is actually a bullish signal. Okay, inside the base, if you see a shakeout candle, a proper, legitimate, identifiable shakeout candle, that is actually a bullish sign. Okay, important point to note here, just because there is a shakeout candle doesn't mean that you buy. Okay, a shakeout tells you that institutional accumulation is happening inside the base. So it's a bullish signal. So before I show you a shakeout example on the chart, let us go back to our original system of buying stock, which is comprised of three steps. Step one is high volume rally. Step two is low volume consolidation. And step three is high volume breakout. So let's go to that. Let me expand this. So this is what it looks like. It's very simple. There's nothing complicated. Okay. So, first, let me explain to you the psychology behind why this is happening. Okay. I have done this in one of my earlier videos recently, I think in the same week or the last week, but I will do it again here because I think it is a very important discussion. So, I want to explain to you what happens behind the curtain when you see a pattern like this. It may not look exactly like this, but you can actually mark the points. Okay. So step one is high volume rally. Step two is this consolidation. And step three is a high volume breakout. And that's your buy point. So in step one, what is happening is both the institutional and retail players are buying the stock. Everybody is piling onto the stock. That is why price goes up. Then the price reaches a point where some of the retail players, or what we call the weak hands, start to become nervous about the rally. They feel that the rally is extended, so they start booking their profits. Obviously, profit booking leads to decrease in price. So when the price goes from point 1 to point 2, this is point 1, point 2, point 3, point 4, point 5, point 6, and so on. So from point 1 to point 2, it is called profit booking. So the retail players, the weaker hands, are getting out of the stock. Who do you think is buying that stock? Who do you think is absorbing that supply? The institutional players, right? They are accumulating the stock. That is why you will see during this time, the volume will be low because it is not the institutions that are selling. It is the retail players, the weaker hands that are selling the stock. There comes a point where the retail people stop selling the stock. Okay. Now the institutions don't know whom to buy the stock from, but they know that there are still some retail players left inside the stock. So, what they do is they start offering a higher price to entice those retail players to get out because those retail players have started experiencing pain because they are losing their much earned gain. So, when you offer them a higher price, you are like enticing them to get rid of the stock. Okay, it's like if you go to buy a house, you go to the owner, you offer like 50 lakh rupees. He will say, no, I will not sell you the house. You offer 75 lakh. He'll say, no, I will not sell you. You offer 1 crore. He will say, no. You offer 3 crore. He will say, no. You offer 5 crore. He will sell you the house. Okay. So it's like the more you increase the price, the more you are enticing the owner of the house to sell out. Similarly, in the stock market, the higher price you offer to the stock, the more players will come forward to sell you their shares at a higher price because now you are trying to reduce their pain. Correct? So, even if the price is going up, that also means that the retail players are getting out. Institutions are forcing the retail players to go out. So, and so on. So, whenever price decreases, it is profit booking by the retail players. Whenever the price increases, it is the institutional player trying to entice the retail players to come out of the stock. And eventually, there comes a time when this churning takes place and the stock is moving from retail hands to the institutional hands. And then comes a time where the retail supply actually stops. So, price contraction happens, volume contraction happens, and actually The stock is now held by institutions, majorly held by institutions. There is no retail player left to sell the stock. So now, if you want to buy the stock, you have to buy it from a retail player, sorry, institutional player. Doesn't matter whether you are a retail guy or whether you are an institutional fund manager. You have to buy the stock from existing shareholders. And who do you think are the existing shareholders? The institutions. Now tell me one thing. If you want to buy a stock from an institution, will the institution sell it to you at a discount? No, they will ask for a premium. That is why you have to pay a higher price to get the stock from the institutional player, because they have been accumulating the stock for a long time. They are not going to sell out easily. So when institutions come in to buy the stock, they will have to pay a premium to accumulate a large chunk of the stock. So it's like two dinosaurs fighting with each other. And you can join the party. You can buy as the stock starts to break out on high volume. The high volume comes because it's institutions transacting with each other. So you might get a chance to enter buy a few shares. Okay. That's when it's not just two institutions transacting. If there were just two institutions transacting the stock, then it's like high volume, low liquidity kind of a situation, correct? But that does not happen. It's like many institutions transacting with many other institutions who are holding on to the stock. So with that flow, you tend to get a entry into the stock because this is an auction market. This is not a normal market. If you go to the grocery to buy bread or eggs or some grocery items, the price of those grocery items don't go up 10 times in 5 minutes. But if you go to buy a museum quality art or painting, the price could go from 1 crore to 10 crore in less than 5 minutes because there is a higher bidder for that painting. So the price goes up like 900% in 5 minutes. Why? Because that's an auction market. Imagine the price of uh, bread, eggs, or groceries going up 900% in 5 minutes. You will go down and burn the parliament, right? You will start protesting on the streets. The grocery market is a normal market. The stock market is an auction market. Anything can happen in the stock market. That's the opportunity. Okay. So eventually your retail supply ends. You get a buy point. You watch, you look at volume, and there will come a breakout day. Okay. You catch that breakout and you enter the stock at this price or 1% above this price. You will draw another line, and that's your buying range. Try to buy all of your shares that you have planned to buy in that buying range. So you need to see these three steps playing out in the market. Step number one, high volume rally. Step number two, low volume consolidation or accumulation by the institutions. And step number three is a high volume breakout. Now you understand what happens behind the curtain. Okay. Now you are in a better position to understand a shakeout. So to shake out, to explain to you what is a shakeout, I will take you to a chart called Cochin Shipyard. There is a nice shakeout candle in this base. So let me first minimize this. Okay. So let's go to Cochin Shipyard. And by the way, this is the Nifty chart. Okay, see three candles closing above. If Nifty closes like this today, it is like three consecutive closings above the low of this candle. That means Market Smith will switch it to rally attempt. Correct? In a rally attempt, we are allowed to take a trade. So which means opportunities are coming up in the market. Just because everybody is selling the stock or everybody is become bearish doesn't mean that I have become bearish. I am observing facts. Okay. The fact is there are three consecutive closes above the low, assuming by 3:30 it remains there. Okay. That is a fact. Second fact is the falling window has been closed by this candle. That's bullish. So two bullish signs that I see. Nice rally attempt developing here. So maybe there could be opportunities. I don't know. If this coincides with stocks, good stocks forming basis, I might want to enter with a small position size just to control my risk and probe the market with small positions in the market just to see how the market is reacting to breakouts. Okay, that's my small take on the market. No advice, no recommendations, just pure education. Okay, let's go to Cochin Shipyard to understand shakeouts. So this is Cochin Shipyard. So I will remove all of these lines. As you can see, I have marked multiple bases here. I have marked points Here the buy points sometimes pull back as well, but I will remove all this. I will remove all this. Now it looks like a clean chart. Okay. Have a look at this breakout. So I will put a marker there. Yeah. Yeah. Have a look at this base. Classic example of a shakeout. Okay. Let's draw the base from here till here. Nice base. Then let's take the path 1, 2, 3, 4. 4 points inside the base. Sorry. Yeah. 4 is here. And fifth point is here. Okay. So 5 points in the base. But the buy point, sorry, the buy point is this point, the high of this candle, that is 930.80. Now, as you can see, there is a problem with this buy point. It's that the distance between the current closing and the yellow line is probably more than 5%. And by the way, I am not looking at comparatives, liquidity, fundamentals here and market analysis here. I'm only looking at technicals. Okay, I'm only trying to focus your attention on the technicals, the base. Okay, we are not looking at comparatives, market and fundamental here. So this is a very focused discussion only on shakeouts. When it comes to actually buying the stock, you have to look at multiple other factors. Okay, so if you look at the distance between the closing price and the yellow line, it is more than 5%. Okay, so it violates our rule. You could buy the stock, no problem. The stock shot up 11% the next day. You could buy the stock, but if you are buying the stock like this, okay, you have to make sure that you go in with a small position size. The market conditions are in an uptrend. You have to be aware that you are taking that additional risk because the distance between the current closing and the yellow line is more than 5%. See, I have never said that if the distance is more than 5%, don't buy the stock. I have never said that. I am saying if it is more than 5%, you run the additional risk when you buy the stock. So to control that risk, either you have to tighten up your stop loss or go in with a small position size or only enter such trades when the market itself is in a confirmed uptrend. That is my argument. So I want you to be flexible when you are approaching the market. Define your parameters, define your boundaries, and if you are taking one step outside that boundary, be cautious. Go in with a small position size. Okay. So this is not to illustrate that you should have taken the trade. This is to illustrate to you the concept of a shakeout. Now, if you see, this is point one. The stock starts to come down, creates a low here, okay, and stock starts to go up. Now, if you see, when the stock begins to go up, there are some people who start buying the stock as it begins to rally here by keeping their stop loss at the low of this candle. Okay, let me mark the low of this candle. Let me put it a let me put a blue line there. Okay, so as the stock starts to go up, people think that it's a pullback. Now the stock will start to go up. Maybe it has bounced off the 21 day. No, it has not bounced off the 21 day. So it starts to pull back. People start to get in there, keep a stop loss at the low of this red candle. Now, institutions are very smart. They know where the stop losses are, right? So what they will do is they will deliberately push the price down and kick out these weak hands or the retail players who have tried to capture this rally by keeping their stop loss here. So this stop loss is triggered by this red candle. As you notice, that candle has got low volume. The volume on that candle is below the blue line. So it is just enough volume to kick out the retail players. It is not the institutions that are selling the stock. It is institutions that are forcing the price of the stock by selling a few shares, selling just enough shares to kick out these retail players, and then buying the stock back again, pushing the stock price up. So basically, what is happening in a shakeout is this is a shakeout candle. Okay. In a shakeout candle, the institutions will deliberately push the price down by selling just enough shares to take out these stop losses. When these stop losses get hit, supply is coming to the market because a stop loss for a buy order is a sell order, right? So these sell orders are getting triggered. That supply that is coming to the market is absorbed by the institutions again. So institutions will sell just enough shares to push the price in down enough to trigger those stop losses. When those stop losses get triggered, that supply is absorbed by the institutions, and then again institutions buy the stock that they originally sold at a slightly higher price, and they start to push the price up. I hope you understand that. Let me repeat it. Institutions will sell just enough stock to push the price down to trigger this stop loss. When the stop loss gets triggered, supply comes to the market. That supply is absorbed by the institutional players first. And then whatever shares they sold, they buy those shares back from the market and thereby pushing the price up. Okay. And continue to buy. See the high volume coming here. That is institutional demand. That's not retail demand. Okay. So the purpose of a shakeout is to shake out the retail players or the weak hands. That is why the volume on this candle is low. If big institutions were actually selling the stock, fearing that the stock might collapse, then this volume would have been higher. Okay. Occasionally you get high volume, but you see on high volume there is not much price movement. Okay. So it's like churning, like institutions changing hands. Okay. It's not panic selling from institutions. Okay, so there is not much price movement. In fact, on this day, the price actually went up. It went up plus 0.02%. So it is not just price. You also have to observe volume to determine what's going on behind the curtain. This is a legitimate shakeout candle to kick out these stop losses, and then the price goes up. So that's a bullish sign. Now, that doesn't mean that you buy on this candle, because when you buy on this candle, you are buying the candle near the low of the base. No, wait for the stock to complete a legitimate base, wait for it to come in the green zone. Here it is still in the red zone, because you know what happens when you buy here. You will keep the stop loss here, and institutions know that, so they will put a second shakeout. There will be a second shakeout to clear out these lows. Okay, so institutions are smart. Now, good thing is in this case that second checkout did not come, but more often than not that second checkout is likely to come. You will notice that when you have enough trading experience. So never buy at the near that low, thinking that oh there is a new support level and all that. Wait for the candle to form a proper base, and then look what happens on the next candle. That's 11% candle. Okay, as per my system, I wait for that 5% distance, that distance between closing price and yellow line to be less than 5%. That is my system. I could buy this stock. Even if I buy this stock, I would go in with a small position size. But for me to buy the stock, the volume has to be extraordinarily large. In this case, it is like 4 times the average daily volume. So I could buy such stocks. I am not discussing uh, comparatives, fundamentals, and things like that here, because those factors will also come into play when I am buying the stock. Now, just a disclaimer, I did not buy this stock. I don't know. I forgot the reason why I rejected this stock. Maybe because of comparative reasons. Maybe the relative strength was not there. Maybe fundamentals was not there. I don't know. I forgot why I did not buy the stock here. But the purpose of this discussion is not to get into whether I bought or not. The purpose of this discussion is to show you that shakeout candle. So you can see high volume rally. The volume here is generally high. Low volume consolidation. The volume here is generally below the blue line. And then high volume breakout with 11% candle. And the shakeout candle is there to show you that shakeout is actually a bullish sign. It drives away retail players out of the market. And then look what happened after that candle. It was a complete, you know, it's a bull run. See how small that candle looks compared to that. This is 11% candle. See how small it looks when you take the context. From here, this yellow line till here, that's a 220% return. The stock has tripled, basically. So you see how powerful that is. You might think that, oh, it's 6% distance between closing price and the yellow line, so I will not buy the stock. But you are missing out. For that 1% distance, extra distance, you are missing out that 200%, right? So you could buy the stock even if the distance between closing price and yellow line is more than 5%, but you have to be going in with the awareness here that you're taking additional risk. The stock could have collapsed from that 11% candle. So position size matters. You have to go in with a small position size, or if you're going with a normal position size, you have to go in with a tighter Stop loss maybe 4% or something like that, rather than 8%. And then keep an eye on volume. If the volume is coming in, you could latch on to uh, a bullish stock, a bull run like this, which propels the stock 220% while creating 3 4 good bases, which I had marked on this chart earlier. I have not marked them here, but that's an opportunity. That's a proper stage to stock. In this entire bull run, the price was always above the blue, the green, and the red, and all the moving averages were sloping up. That's the best time to be in a stock. Okay. Thank you so much.